Hello, I'm Abhilash Narayan, investment strategist at HSBC. Welcome to the latest edition of India Brief, where we discuss our house views about Indian equities and fixed income markets. Now, despite US and Iran agreeing on a ceasefire almost 1 month back, the Strait of Hormuz still remains effectively closed. As a result, the higher oil prices are likely to result in wider current account deficit for India and have also clouded the growth outlook over the next 12 to 18 months. The Reserve Bank of India kept policy rates unchanged in its April Monetary Policy Committee meeting, in line with our expectations, but the central bank also downgraded India's GDP growth forecast while raising the inflation forecast. We expect the RBI to keep rates unchanged as we believe that inflation should remain below the 6% threshold. So what does this mean for financial markets? Well, firstly, we retain our tactical mild underweight stance on Indian equities as we believe that they are likely to struggle to outperform global equities until oil prices start to normalize. While valuations have clearly moderated, we believe the weak investor sentiment due to higher oil prices and India's limited exposure to the AI investment cycle are likely to be near-term drags. As a result, we favor the more defensive large-cap stocks over small and mid-cap stocks, and from a sector perspective, we favor more domestically oriented sectors, and we are overweight on financials and industrials. On the fixed income side, we are neutral on Indian local currency bonds. While we acknowledge the risk from higher inflation and potentially higher bond supply, the current yield of around 7% offers investors an attractive carry and adequate risk premium in our assessment. We do expect yields to remain largely range-bound over the next few months before potentially edging lower towards later part of the year.